There's a great opportunity to make money in the markets these days, but a lot of people aren't talking about it, usually in the way we normally think about it. And it's not the stock market, but that's what we're going to talk about tonight. And as always, tonight is Wealthy Wednesday. So we're here to answer your questions. If you have any money questions, business, stocks, economics, ooh, a little tired, y'all. Economics. If it's about money, we'll talk about it, y'all. But I'm Kamari Ellis. Welcome to the Finance Rebel Show. Every Wednesday, we talk about money, right? So I have been in the tax and financial services businesses for over 30 years. And I love to talk to my people because this show is all about making wealth black again. So feel free to come on in. Tell me who you are. Tell me where you're hailing from and what questions you might have. But we're going to get into a couple of topics, and then I'll definitely open it up to the floor and answer any money questions you might have. All right. But let me do something real quick because I didn't share this out um, early enough and coming on a little bit late, but let's get to it, y'all. Let's get to it. So bear with me for about 30 seconds as I share this out. And it looks a little weird right now for me because I don't really see it anywhere. But it is streaming somewhere. It's streaming somewhere. I just can't see it. But I want to talk about it, right? Today, 10-year bonds, all-time high, almost at 5%. Haven't been this high in quite a long time. And a lot of people don't talk about bonds because they're boring and they're a bit intricate. And so I want to talk about them because there's a opportunity of a lifetime on the plate right now, or on the table right now. And I know a lot of people are not necessarily thinking about it. And so I think this is a great time to talk about it. It's an investment that's open to anybody, right? It's a pretty safe investment. And these are not the bonds that grandma gave to y'all, those EE bonds. I'm talking about government treasury bonds. So if you want to hear about those, we'll definitely get into it while you're waiting, right? Do me a favor to like, share, and comment. Let me know again where you're hailing from, what your name is, so we can get into it and I can talk to you by name. Y'all know I love to have these sessions, and it's almost like a little community town hall family gathering type situation. So again, come on in. Still Rocks was here early. All right, welcome. Oops, wrong board. Yep, welcome. And oh, Miss Edie is in the building. How you been? I haven't seen you in a while. I haven't seen you on the YouTubes though, so I appreciate you immensely. Thank you for sharing. Always sharing, always commenting. Excuse me, y'all. But always showing support. So thank you again. It's not necessarily about me. It's about getting a good information out to these folks. Because there's a lot of people out here that love to rip and run and brag and boast, but a lot of times their information isn't the best. So, y'all probably heard me talk about that quite a bit over the years. I'm going to fall back on that because y'all might not like this, but in my opinion, a lot of these scammers are being enabled by all the attention that they get because they tell these fantastic tall tales. They sound wonderful, but y'all won't do the education to secure yourself and defend yourself, right? At the end of the day, scammers are going to be scammers. They've always been here. They were in the Bible and other quote unquote sacred divine text, right? They've been around. They're not going anywhere. Anybody remember when Chris Rock was talking about the tiger? And he was like, can't be mad at the tiger because the tiger went tiger because the tiger bit off Sigmund or Freud, which one of them, right? He had enough and he got frustrated and he attacked. Well, guess what? Nothing is really going to change their nature. If a person is the way it is, then we must accept that and then defend ourselves, fortify ourselves so we can ultimately protect ourselves, our money, our wealth, and our families' money and wealth as well. So you got to think about it in that way. But like I said, I'm just sharing this out in a couple of places. So give me a second. Give me a second. I was trying to share it on my YouTube. Excuse me, not on my YouTube, on my Facebook, but I don't see it. I must have did something wrong. Oh well, I guess I did something wrong. Oh no, it is up. It is up. Okay, there it is. All right, now I can share this. I can share this around, and then we can get back to y'all, and we can have a good old time. So give me 1 second. 1 second. But again, as I'm talking about this, we're talking about bonds tonight, how to make money in bonds. Again, a relatively safe investment. Listen, there is no free lunch. There is risk in everything. All right. However, this one thing is backed by government money, and the government has never missed a payment. So that's why I like them. Anytime you can go somewhere and get 5% on your money and not get any risk, I think that's a great day. I think that's a great day. So give me 1 second. That's Siegfried and Roy stage act with the tiger. Wild animals are not pets. That's right. Yes, I remember Chris Rock's commentary on that. But listen, I think that is. I think. I think that's wild animals, right? Hammers, wild animals, and I like it. But it is what it is. And so we can be fools and think that they're going to change themselves and their nature. They're not. Tiger one tiger, scammers one scammers. It's not going to change, folks. So the question is, what are you going to do about it? Because again, I keep seeing all of these stories or hear about in these stories. People giving people money, 6 figures, like good money, hard earned money that they spend. 6 figures. No lawyer involved, no accountant involved, no due diligence. And they just gave it up. I mean, I guess people don't really appreciate their hard earned money, but I do. And I appreciate it for you. But again, I can only do but so much, y'all. I'm not a miracle worker. I'm just a man who cares about the community. That's about it. That's about it. So give me 2, 3, 4, maybe 5 more seconds, and I'm right back at y'all. Right back at y'all. While you're waiting, look up what treasury bonds are, right? Look up what treasury bonds are so you can get a jump on tonight's lesson. Because again, I am just a guide. I am not the end all be all. Everybody should be doing their own research. Their own research. Again, ladies and gentlemen, doing your own research. I'm not saying you have to be an expert, but by doing your own research, you can say, oh, this doesn't sound right. All right. But again, I was been talking about bonds, and I want to show you all a clip. Give me 1 second. I just said that already, right? I want to show you something. Let me tell you something. It's funny. I have this new setup, and it's not so new because I've had it for years, but it's still new to me. Where I'm broadcasting with my Mac Mini, and it's still strange to me. And so I guess I need to do, I don't know, a little bit more trial error test, all of the above. But I wanted to show you all who they call the Bond King, right? There's a guy that they call the Bond King who's been around for years and years and years. He used to run what's called PIMCO. Y'all look up PIMCO, and you'll see this gentleman has been around for decades. And now he is calling for, and y'all know I'm not really big on the peoples, right? I don't really care about the peoples, but this gives you a little bit of perspective. Give you a little bit of perspective. So Bill Gross is his name. Bill Gross is his name. They call him the Bond King. He's been around forever. And he is not usually that far off. Again, always do your own research, do your own due diligence. You can have some people that you look to for some guidance, but ultimately, the responsibility is yours. All right. Responsibility is yours. And so, as I cue this up for everybody, I wanted to show you some things. And he's talking about the beauty, the benefit and beauty of bonds. And after that, we'll get into what a bond is, how you should think about a bond, um, where the placing of the bond is, right? And so, I always try to come with a straight up educational foundation with everything because I believe from my experience and my education that when a person has their own education, they're able to form their own investment thesis or investment ideas, and they can do that, and they can start saying, "Hey, this makes sense. This doesn't make sense." But if all you do is lean on somebody else's understanding, you're kind of subject to them doing crazy things. I'm trying not to cuss today, y'all. Trying to do Lent early. I don't even believe in that. I'm just joking around. But I wanted to show you something. All right, let's do this. Give me 1 second. The bonds, how they work in your overall portfolio, your overall asset allocation, and how you can make some money with them. I mean, there's a lot of money to be made. And I'm going to show this in 1 second. Where is my stuff? Here we go. Here we go. My apologies, everybody. I have an engineer and an op, and I don't have to do this stuff anymore. Somebody else will handle it all. I'll just run my mouth. So, Thunder's in the building too. What's up, Thunder? By the way, I didn't give Miss Edith the horn. So welcome, welcome, welcome. And the horns for Thunder. And welcome, welcome, welcome. So I wanted to do that because I always like to celebrate everybody to come here. I appreciate you all being here. You could have been anywhere else, but you're with me tonight. So kudos to you all. All right. So again, I wanted to show you Bill Gross, show you what Billy's talking about. Bill's been around for a long time. Pulling it up right now. Un momento. Un momento. Sounds on because y'all know I've had several times when I flubbed the sound. All right, here we go. All right, so we're talking about Bill Gross, the head of PIMCO. PIMCO used to manage, I want to say trillions of dollars. No, many, many billions, almost trillions of dollars. And he mainly concentrated on bonds. So I thought this was a good clip and a good segment for y'all to all check out. So here we go.
Let's talk about it all with somebody who is.
And that's not giving me any sound. Why not? That's weird. Give me 1 second, y'all. You are special. We're all special, right? Like I said, I appreciate you being here probably many years now. One of my first supporters. I'm gonna break out my old Cash App and show y'all how many times you gave me money, like before I even asked for it. So I appreciate you. but my internet is interneting.
Let's talk about it all with somebody.
And I don't know why. Oh boy. So let's see why it's not talking.
Who has forgotten.
All right, here we go.
Let's talk about it all with somebody who has forgotten more about the bond market than most of us will ever know, and that is PIMCO co-founder Bill Gross. There you go. It's true, Bill. Many investors call you the bond king. You've made money, but you can do anything you want now. You're literally unconstrained, Bill Gross, as we will say. What do you make of what is happening right now? And is there a level that you see the 10-year stopping at? Could we go to 5 or 7?
All right, so a quick note, right? They're going to talk to you kind of more in investment jargon. Not too much. If y'all got the book, I told y'all what book to get. I told y'all to get the book, right? How Money Works. I know Mercedes got the book. Everybody should have this book, right? I don't make any money off of it. Maybe I'll grab an Amazon link and I'll throw it in the chat or put it in the comment section. But everybody should get that book. All right, so when he says the 10-year, he's talking about the 10-year Treasury bond. All right, he's talking about the 10-year Treasury bond. And we'll come back and we'll talk about what bonds are, what bonds are not. Bonds are not stocks, just to let you know. But bonds are something else.
7%? 5 or 7%?
Well, I think we can go to 5, Brian. The market certainly is oversold at the moment in anticipation of Treasury.
So when they say oversold, also that means people typically are in their feelings, right? Emotions drive all markets, bond markets, stock markets, currency markets. There's usually some form of emotion that is at play that drives people to sell. Right now, the economy is a little up in air right now. People aren't sure what to do, if everything's going to collapse or if it's going to be fine. Again, people are in their feelings, so they don't know what to do. And when they say oversold, when people sell bonds, Treasury yields go up. But I don't want to go into that too much. Just yet, I'll get into it a little bit more.
Treasury supplies in anticipation of higher for longer in terms of the Fed and the Fed's own quantitative tightening program and
quantitative tightening, quantitative easing, some terms that are thrown around when talking about the Federal Reserve and bonds, right? So quantitative easing is when the Federal Reserve is out on the streets buying bonds from mortgage-backed securities and several other things, but they're putting money on the streets. They put money on the streets to make the ease of money or the ease of capital a lot easier for borrowing for individuals, especially for banks and other businesses, right? When they say quantitative tightening, they mean that the Fed is taking money out of the street, making it harder for people to have money to borrow, buy homes, borrow and get business loans and things like that.
In the last few days, an interesting new aspect to the bond market, ETFs, exchange traded funds, large bond ETFs, numbering in the 90 to $100 billion range. They're experiencing higher volume, which means to me that small investors, vigilantes, small vigilantes, not large vigilantes, but small vigilantes are selling. And when you combine all three, the Treasury, the Fed, the retail market with ETFs, then you have an explanation for what's happening. And I think maybe 5% caps it for the near term.
So when he talks about these ETFs, again, ETFs, exchange traded funds and supply and demand. So people go to these funds, they buy these ETFs then go to the market and they buy bonds. So when they are selling, they are taking money out of the supply for bonds. When they're buying up bonds, right? Supply and demand runs everything, y'all. Economics runs everything. So when you see these big movements, right, that's what a lot of times is changing what's going on in the market.
It depends, of course, on inflation, depends on economic growth we'll see going forward.
Okay, well, 5% actually to some people might sound pretty good. I assume you're talking about the TLT and some other ETFs. Bill, but you mentioned rising issuance, maybe just more bonds put on the markets because of deficits. Is that what has happened recently? Because what I guess I'm confused by is that interest rates have been going up for 2 years, but it feels like in the last just week or 2 or 3, something really changed. Is there something broken in the bond market right now?
Well, I think it's recognition of the supply on the longer end. What we've seen in the last year and a half or so is the Fed raising interest rates from basically 0 to 5.5%. And that's, had an effect on the yield curve, a negative term yield curve. But now what we're seeing is a recognition of the Treasury deficit that is $2 trillion plus, and that's affecting the long end, as is, I think, in the last few days, the selling of ETFs, which basically own long bonds as opposed to short bonds. So we're seeing a higher yield market, and we're seeing a less negative yield curve, which I think is very important.
National debt is soaring, 33 trillion and counting.
So I don't want to get you all lost in the technicals here. I know there might have been some terms there that they're talking about: long side, short side. All that means is how long are the bonds going to be out there for? How soon will they mature? Bonds tend to mature. Well, U.S. Treasury bonds mature, meaning you put the money in. But you know what? Let's do this. I'll come back to this because I want to make sure everybody has a good understanding. So bonds, right? A lot of people don't think about bonds when they think about stocks because bonds are boring. Matter of fact, shout out to Lawrence. My guy, Lawrence, right? He says, boo. Actually, Lawrence, you should change your stance on that right away because you're incorrect about that. But especially for your cash holdings, it's a great place to store cash and it's damn near risk-free. So, what are bonds? Bonds are basically loans. People give money to governments, whether it's the United States government, the city of Philadelphia, which is a municipality, right? There's different types of bonds, but at the core, they're all loans. So people, banks, businesses give money to these governments as a loan. And they need this money as a loan because governments need cash, because a lot of times they don't get enough money in from taxes to really run the business, whether it's the roads, sanitation, the actual tax collectors, right? They need money to float when they're doing things just like everybody else. And listen, I was doing a presentation to the 10K project. If you go back to my YouTube catalog, you'll see an interview out there with them. They're basically a group of Black women who started gathering Black people together to put their funds together to invest in businesses. So we kind of started talking about bonds, right? But again, bonds, when we break it down, simple things, right? Most financial things you can kind of relate to your own family household. You might have run a little short for money. You might go seek a loan from a brother or a friend. Same thing for the government. They might be running a little short running payroll. They might be a little short paving roads. They might be a little short building that new missile or that new fighter jet. They go to say, hey, taxpayers, big banks, loan us some monies, buy some bonds. And then what we'll do is we'll pay you back some interest over the life of that bond. And when it's all said and done, we will pay you back in whole. Now, bonds come in sometimes 3 months, 6 month bonds, 2 year, 5 year, 10 year, 30-year bonds. Also, corporations issue bonds as well. Same premise, they're loaning money. So again, it's something for you to think about. But again, they're not as sexy as stocks, right? And y'all know I love the market, stock markets, right? But the bond market is actually bigger than the stock market. A lot of people don't realize that though, right? And a lot of times, and again, I am not talking about your granny and my mom and Nana's bonds. that they get all their babies when they born. They get them a bond, and they're great. But these are different. These are a little bit different. Normally, you have to have, for your average individual, you can go, and I'm talking about treasury bonds, right? You can go buy them directly from the United States government. You can open up a brokerage savings account, and you can buy them. So I don't know if y'all remember when I broke down asset allocation to all of you, right? When I told you at the top of the pyramid, you look at the most risky and speculative things like crypto or private equity or hedge fund investments, right? At the bottom of the pyramid, everything about it. And I'm not trying to be a Delta or a member of Jay-Z's gang of Rockefeller, but at the bottom of that pyramid, at the pure base, is cash and cash like equivalents. Treasury bonds would fit in cash and cash like equivalents. So a lot of times people say, I don't want to just have money sitting in the bank. All right, cool. I get it. I want to get something a little bit better. Well, one thing you can do is you can get treasury bonds. Again, they're paying 5% for the 10-year treasury. You want to get interest, and then at the point that when they're done using those funds, you get your money back. And so you can go buy them from a brokerage account, put them in there, right? I tell you all, you should have at least a year's worth of income and revenue set aside in cash. Now, I know y'all hate that. Y'all think I'm crazy, but we just went through COVID, and that proved my point. Give myself the horns. I can't tell you how many people that said, well, Kamari, I didn't get a year's worth of saving, but I did start to save. And when COVID hit, it saved my life. But again, oh man, we got some more people in the house. So, but again, you want to look at all of these different assets. It's not just stocks. It's not just crypto. It's not just real estate. You want to look at all of these different assets and put them into play, understand how they play, because they all have their own different function and purpose. If any of you all, I'm going to use a football analogy, right? The quarterback is you. The other assets are other positions on the football team. Or should I say, the coach is you. Everything else on the football team is your different assets, whether it's your wide receiver that has a job, tight end has a job, a running back has a job. I hope I'm not losing any of you all with the sports analogy, but assets are the same way. They all have a job, and you got to deploy them. For example, everybody knows about the Hail Mary. The positions that usually are at play for the Hail Mary are the quarterback and usually a wide receiver. And then you have other positions like offensive line that protects the quarterback to give the quarterback enough time to throw the ball to the wide receiver that just ran all out. If you can think about Deion Sanders in his prime, Chad Ocho, wrong position. Deion is actually a cornerback. He's not a wide receiver. Chad Ochocinco is Mike Quick. I'm showing my age right now. Jerry Rice. Those are all wide receivers, okay? The person that was throwing in the ball, that's the quarterback. And again, that's a very, very low probability play, since everybody loves to talk about running the play, right? But the guy who runs the ball, you know, probably my favorite football player is, what is his name? I'm not a super duper sports fan anymore, y'all. But I love my guy, time for some action. What is his name? He used to play for the Seattle. And he always says, I'm about that action, boss. What is his name? Somebody help me out here. I can't think of his name. This is bad. He is one of my favorite players. I love his personality. He's hilarious to me. Marshawn Lynch, thank you. Thank you, Jeffrey. Right. But he runs the ball. And probably the greatest, and I'm showing my age here, Walter Payton, Barry Sanders, some of the best running backs ever. But they have a position. They don't get a whole lot of yardage, right? And so when you think about bonds versus stock, they're kind of similar, right? Your bonds are there to kind of protect the quarterback or protect your money. They're not supposed to be super sexy. They're not supposed to be super stellar. Leave that for the wide receivers and sometimes the tight ends. But again, I don't want to keep using football references, but if you can relate investing to various assets or investments, you kind of get it. You kind of get it. Emmett was cool. Emmett's cool. I'm not a Dallas fan though, right? I am from Philly. So you already know what that means. You already know what that means. But again, you want to look at each asset, put it to use for the thing that it's there for, right? And again, at the bottom of that pyramid, it's cash. How do you get cash? The majority of our audience is individuals, work every day, 9 to 5. Some of you have businesses, right? But you're self-employed. You don't have a whole bunch of employees that are coming there making the widgets, right? Or making the donuts. You are the one. So how are you using your money to put you in position to protect you from recessions or bonehead politicians who could never make up their mind? By the way, the government shutdown was avoided for 47 days, 3 days ago. So now we got 44 days. And yesterday, the daggone Speaker of the House was kicked out. The Republicans are having a full-fledged meltdown, and they're acting like kids in a romper room without any parental guidance. So we might have a real shutdown November 17th, but you want to be careful. You want to be safe. You want to save your money. And here with bonds is another alternative to use those funds to keep you safe, whatever your goals are, right? A lot of times people, when they come to me and say, come on, what's that hot stock tip? Or what's that hot crypto tip? All crypto tips, all stock tips, they all suck, right? We don't want no hot nothing. We want sound, secure strategy. And you can do that, right? So, you know what, let me do this. Let me find an asset allocation pyramid. I've shown y'all this plenty of times, but I will show you it again. And you can easily find this on Investopedia, Investopedia.com. So give me 1 second. I'll pull that up. Because I know people listen to this podcast and they're watching live right now. What? Aren't you bugging? I think we need to shut down stock-wise. No, we don't need to shut down. 1.5 million government workers are going to shut down. It's going to hurt our seniors. It's going to hurt our service, our military service, which you are one of the men who served, right? It's not a good thing. It's going to be bad for the IRS. Now, I do agree that sometimes you need to go to the extreme. I don't think this is one of them. I think, and I know this is not going to happen. People need to get more involved in politics and put a foot to the ass of their politicians, whether it be Congress, city council, state rep, state senate, really understanding it and understanding policy. But I get it. And Lawrence is probably just razzing me a little bit. But let me pull this up. As I said, for a while, tangent. Give me 1 second. Does anybody have any questions about bonds? Go ahead and throw them in the chat, as you always do. Let me see this here. This is interesting. This might be something good to show you all. All right, so let me do this just in case if I didn't do a proper and good and excellent job. I want to show you all this. Give me 1 second. I want to show you all this. I want to show you all this. Maybe this will help get the point across a little bit more.
When determining the amount of risk you can handle, consider the time horizon and bankroll. How long can the money remain invested before you need it? If you have $20,000 but plan to use it in a year for a down payment on a house, investing in high-risk stocks is unwise. With a long time horizon, there's time to recoup losses. If that $20,000 was earmarked for a lakeside cottage you'll buy in 10 years, you can invest in high-risk stocks that might be more volatile. And what can you stand to lose? Suppose someone with a bankroll of $5 million and someone else with a $50,000 bankroll both buy $25,000 worth of stock. The stock's performance will impact the person with the smaller bankroll much more. Once you know your time horizon and bankroll, try
Time horizon is super important, y'all.
the risk pyramid approach for balancing your assets. The pyramid has 3 tiers. The base provides the support. It consists of investments that are low in risk and have foreseeable.
That cash is the support. That's why I always talk about it. Again, y'all think I'm crazy, but I talk about it for a reason. But this is a little bit more eloquent than me.
Returns like CDs and bonds. Medium risk investment offers stable returns and capital
You heard him say bonds, right? Bonds are part of the support.
appreciation, such as mutual funds or real estate, comprise the middle. The summit contains high risk investments. It's money you can lose without any serious repercussions, such
Money you can lose. The summit, the top of the pyramid, right? That's the summit. That's where you put money you can lose. But I'm going to show y'all an example of the pyramid asset allocation.
as collectibles. Investors who want more risk in their portfolios can increase the summit by decreasing the middle and base. Those wanting less risk can do the opposite.
All right. Let me know, y'all. Did that make sense to you all? Throw that in the chat. Let me know if that made sense to you all. And if it didn't make sense to you, let me know what didn't make sense. Let's talk about it. Let's talk about it. All right. Anthony is in the building. I'm sorry, Anthony. I did see you. What do you buy you number 5 thumbs up on YouTube? I see them on YouTube now. All right, Thunder gets it. Said 100%. All right, cool. Listen, the reason why I'm saying that hot stock tips don't matter is based on that, right? When you look at the history of stocks and these hot stock tips, they usually fizzle out before they get a chance to get hot, unless they burn them, like with the clap or something. But that's a whole other conversation. So, when we talk about bonds, a lot of people don't think about it because folks don't talk about it. Even now, I think about it because of asset allocation with you all. But I put it up today because, again, the 10-year is at some of the all-time highs over the last 20 years. So I thought now would be a good time to talk about it. And when you're thinking about how much money you should be investing, where should that money go? You should do that. And if you've been rocking with me for a while, y'all know I got to direct money via a bucket system. Buckets of money, right? So I have first bucket, you put your money in, you get paid. You put put money in bucket number 1. Bucket number 1 is money that you don't need. Consists of your emergency fund and any other savings, right? The money you put in bucket number 1 should be invested in things that are low risk, because it's that bucket number 1 is for things that you might need in a year or less. So that's how you invest it. Bucket number 2 are things you might be thinking about 1 to 5 years. So that might be a house. And then you adjust it based upon, you invest it based upon your time horizon. They talked about time horizon in that video. Now, when I was a financial advisor, they would always talk about, is the brokerage companies who I worked for, who I slaved for, who I was abused by. But that's a whole other conversation, right? They would talk about risk tolerance forms. So they would want me to always get a risk tolerance form. And I hated those forms, and I know why they did it. But they wanted me to get a risk tolerance form. And they would ask questions like, how will you feel if all of your money disappeared overnight, or if all of your money dropped by 50% overnight? But what I quickly realized is that because people are really greedy, people's answers will change based upon the state of the market. If the market's up, they'll say, oh, I'm okay with a 50% drop because they think it's going to bounce back right away. However, if the market's down, their answers will change. And so I never really liked asset allocation forms not asset allocation forms, risk tolerance forms, because all financial advisors, they want you to get risk tolerance forms that say that we are investing the money based upon the client's risk tolerance. And we're not, because they're supposed to get investments that are suitable for them. Suitability is a real big thing in the compliance world of investments. But we're only supposed to recommend or put them in investments that are suitable for them based on their overall situation and their asset allocation. And I would say garbage in, garbage out, because a lot of times the risk tolerance forms are skewed. The data is skewed. The data is garbage because psychologically and emotionally, people are saying, oh, market's up. I'm ready to be aggressive. The rest of the people around me are excited. They think nothing can ever change. The sky's never going to fall. But I know, because I've been through several market cycles, that markets will go up and markets will go down. And that's just markets in general. Now, this market is a little bit different because this market has been pushed up and propped up because the Feds, as we talked about earlier, has been putting so much cheap money into the markets. Now they're starting to pull that money out. They put cheap money in the market to help support the real estate market. That's why now everybody wants to be a real estate investor. Now, I'm going to say this. A large portion of my clients are real estate investors. And I have this same talk with them. And I try to talk some sense into them because a lot of them now are able to get hard money because there's access to capital there. I don't know if that's going to be like that forever. And I don't know if they're ready for this as it really, really changes. And a lot of the bigger developers and investors are bracing themselves for a big change in the market. But again, once you understand asset allocation, you'll be able to be a greater investor, a better investor. All right. So Lawrence says it wouldn't have hurt government employees. We get back pay. But when do you get the back pay? Come on, Lawrence. When do you get everybody most people can't survive $1,000 emergency, right? Government employees are no different. Y'all, we just had a government shutdown about 4 or 5 years ago. A lot of people were fucked up. They was messed up in the game out there, y'all. They was doing all kinds of stuff that they ain't want to have to do. Some of them had to go see Mr. Nate. I'm not going to talk about Mr. Nate, though. Put a 1 in the chat if y'all know who I'm talking about when I say Mr. Nate. Some of y'all. But all right, let's get back to the rest. Does anybody have any questions about bonds? I want to make sure we address those. Go ahead and throw those in the chat if you have any questions about bonds, treasury bonds. That's what we're talking about. All right, now I want to get back to Bill Gross so we can get through that. And then we can talk some more about bonds and why they're so important.
Deficit, despite what some people may hear, is actually on the rise. It is not going down. It is going up. But debts and deficits, Bill, have not mattered, at least so far. Are we seeing a moment now where they are starting to matter? And on a macro level, is the U.S. going to be okay? I mean, if I'm S&P or Moody's, am I looking at a debt downgrade for the U.S.?
Well, we've seen a minor one already. But I think what's happened is...
Now, when they say debt downgrade, I don't know if everybody knows what a debt downgrade is, right? So think about your credit score. If you spend too much money on your credit cards and you got a mortgage and a car payment, and then you go out and you be like, all right, YOLO, I'm going to just do whatever I want to do and spend my money the way I want to. The credit bureaus will say, you know what? You had that beautiful 850. It was perfect. Now it's going to be 800 or 750 or 700. You miss a mortgage payment, it gets dinged even harder. You miss a car payment, it gets dinged even harder, right? So you have to keep those things in mind, that when you pay on your credit, or when they're looking at your credit, they're looking at your debt to income, right? They're looking at how big of a load do you have. And I'm not the credit expert. I got to get Marquia back on to talk about that. But all of those things, the bond ratings are the same thing for big governments, whether it be a town or national government or anything like that. We have seen, a matter of fact, debt ratings also impact corporations as well. So when you see companies be AAA or triple B, those are how they score those. So AAA is the best. I think C or D is the least or the worst rating you could have. So those are the things you want to keep an eye out for. But that's what Bill Gross is talking about in terms of a debt rating change or downgrade.
Is that the supply of longer-term bonds has been recognized by the market in the last month or two, as opposed to where we were a few months ago. And the higher interest rates, which are self-fulfilling in terms of higher yields, leading to larger deficits, et cetera, et cetera, et cetera. And so, the bond market is a captive of not only the Treasury market and Treasury supply, the Fed, and as I mentioned, the retail bond vigilantes, which don't like 3 to 4% price declines over the last week.
Can the U.S., can taxpayers afford this? We're nearing $1 trillion in just interest on the national debt. And again, maybe modern monetary theory kicks in here. Money doesn't actually have any meaning. I don't know, but I do wonder, as a nation, can we afford it?
Well, yes, and you mentioned new monetary theory. The combination of fiscal and monetary policy is something relatively recently in the last 3, 4, 5 years, and it basically suggests that the Treasury can run a deficit of any proportion because the Fed will buy treasuries and keep interest rates relatively low. Now that leads to inflation, as we've seen here in the past 6 to 12 months, but ultimately there's no problem in terms of surviving from the standpoint of the financial markets. The Fed will just buy what the Treasury issues.
What if the key to analyzing
All right,
stock growth in real time?
Everybody got something out of that. I know I'm a nerd. I can sit watching. There was a couple of things that made me cringe. I was like, oh boy, maybe this is too technical. But this is some of the things you have to do, right? If you really want to become a master of your money, you really have to increase your language, your financial language. That's a great way to increase your financial fluency. Now, I saw a couple of questions and comments in the chat coming right to you. Before we get too far, remember, everybody, we are watching the Finance Robo Show. Y'all know every Wednesday we do our Wealthy Wednesday segment where I answer your money questions: business, stocks, bonds, economics, right? I'm going back, as I always say, bonds. People rarely talk about bonds. And I'm like, oh, okay, today we need to talk about bonds. So today we're talking about bonds specifically, right? But again, I see a couple questions. Do me a favor, if y'all appreciate this, find value in it, make sure you love the likes, or hit the likes, or smash the like button, as all the veteran YouTubers say, right? It triggers the algorithm to let them know that you appreciate you appreciate the show. Excuse me. All right, so let's answer some of these. All right. Anthony says we can't afford it. Why can't we afford it, Anthony? Says who? Based on what? Let me know. All right, Akira's in the building. Welcome, Akira. All right, she says, are you still able to get these from the Treasury bond? Yes, you can. Yes, you can. There's a Treasury bill auction every other week or every month or something like that. And I want to say, if you go to Fed Direct, I want to say it is. Right. Fed, no, wrong. wrong website. Hold on. There's a website, and also you can go to your brokerage account. Let me find the actual website because I just typed it wrong. 2 seconds. 2 seconds. Where'd it go? Where? Treasury Direct. That's what it is. Treasury Direct. All right, give me 1 second, y'all. Just want to throw this up on the screen so y'all can do this. And by the way, y'all should go look at Treasury Direct and peruse it and just look at it and do a deep dive on it just so you can get a better understanding of bonds. I mean, it is a major asset class. So I would encourage you all to check out Treasury Direct so you could have a better understanding of bonds. So there it is right there. It's not the best website. The government is not the best in technology at all. All right. What is... All right, so again, Treasury Direct. Excuse me, treasurydirect.gov, not .com. Treasurydirect.gov. Treasurydirect.gov. You can buy the I-bonds there. You can buy treasuries there. I would encourage all of you to open up an account there. But like I said before, if you open up a brokerage account, a full service one, you should be able to buy treasury bonds in your brokerage account as well, usually in increments of $1,000. So again, a good strategy is you get $1,000, throw it into some treasuries, 5% right now, damn near guaranteed. Again, there's no such thing as no risk. There is no free lunch, but it's way better than putting your money in the bank and just letting it sit. And banks are paying a pretty good rate right now, but banks also go bankrupt. We just saw that with Silicon Valley. The U.S. government, not so much. Not to say that it will never happen or it can't ever happen. I'm not going to say that. But if the U.S. Treasury can't pay its bills, that means we have far more things to worry about than the money in our bonds. I'll just say that. All right, so let's get, all right, I answered that question. Vermishan, right? I haven't seen you in a while. How you doing? Welcome. It's excellent material as always. I appreciate that. All right, Anthony says can't afford it. Still waiting on that answer. All right. What is your opinion on various bonds other than government bonds, such as revenue generating bonds, or tax-free bonds, right? Revenue generating bonds, I'm assuming you're talking about municipal bonds. Tax-free bonds, again, are typically municipal bonds. I think they all have their place in your investing, right? Here's an example, right? Let's say you're getting up in age and you want to start putting your money into vehicles that are not tax heavy, or you want to have a tax-free income stream. You put them in municipal bonds. What are municipal bonds? Municipal bonds are those bonds that are issued by municipalities, states, towns, cities. I'm in the city of Philadelphia. They issue muni bonds. You could also buy muni bonds inside of ETFs or mutual funds. There's a lot of way of getting to them. But again, what is your strategy? It's not just about buying the hot, sexy thing, y'all. It's about getting the thing that strategically makes sense for y'all. Now, we're talking about muni bonds, right? Muni bonds usually don't pay the higher yield. They pay a lower yield. Why? Because you don't pay any tax on the interest. You will, however, pay tax when you sell them on the capital gains. But again, I don't want to go down that rabbit hole and be too technical. All right. All right. Anthony says, I like how you have your own clip, like my own gun. What is your tip to get better with money? My tip to get better with money is educate yourselves. Financial literacy sucks. Financial literacy has been hijacked, right? The real term is financial fluency, financial education. And I say start. I think this is a great book to start with, How Money Works, right? And the reason why I say financial literacy, I mean, I know everybody says it, and I'm the rebel on it. People say I'm contrarian, I just got to say something else. But when you really think about it, the term financial literacy has been hijacked by banks and credit card companies. And all they want you to do is spend money and pay them interest, right? So if their whole goal, their whole mission is to get you on their excuse my language, y'all. I've been hanging with some of my elders. But if their whole mission is to get you to use their products to give them interest, not to build wealth for you, yourself, your family, and community, but to put money in their pockets to make them rich. How does that make sense? If you ever go to any of these quote unquote financial literacy courses, what do they teach you? How to balance a checkbook, how to get credit cards, to get ready for a mortgage. And listen, we're all consumers. All of those things are important. They are. But what's the most important thing? What's this supposed to really be about? Is this really supposed to be about getting foreigns and fancy clothes and buying luxury cars and stuff like that? Or is it really to really use money as a tool? Money is a tool at the end of the day. And if you just become haphazard with your tools, they tend to do harm. For example, what's the saying? If the only tool you have is a hammer, you start to see everything as a nail. And what happens when you start flinging that hammer around? Shit usually gets broken. And you can see that with all the people who have exorbitant credit cards. Credit card balances are going up. Like all-time highs right now. Check the Fed data. But I guess all of these advertisements, all of these sponsorships, all of these promotions on social media to encourage people to run the play, to get business credit or credit funding, when these people don't even understand revenue, the terms of income, taxes, I feel is super irresponsible. Actually, I think it's criminal, deeper than irresponsible. It's criminal, in my opinion. But, everybody's going to say it's capitalism. Well, we just talked about this earlier, right? And I know the majority of my audience is Black folks. So when I talk to y'all about this, y'all get it. So the very system that we're working at now has always been an enemy to us, treated us like an animal, right? What's really going to change? So you have to change. You have to fortify yourself. When these credit card companies are trying to pitch this financial literacy, okay, cool. Credit cards can be used. Do you truly understand how they can be used? Or do you understand that they are a trap 9 times out of 10? And maybe it's better to spend more time and get to know yourself and what's really important to yourself, instead of just swallowing all of this consumerism and materialistic things that they're shoving down our throats every single freaking day. I think that's the better thing to do. Don Johnson's in the building. That's right. Run the play. Can we start a hashtag called "Fuck the Play"? I mean, that's, excuse my language, y'all, but that's just how I feel. And anybody who says that, and I know it's becoming part of the language, and I know a lot of people don't mean it in that way. It's just a cool thing to say. But words have power, and we should use words intentionally. I know I'm getting older. I sound like my dad at times, right? But, you got to think about that. Thank you, Anthony. Thank you for your expertise, and thank you for being here. By the way, Everybody go follow About That Wallet. Anthony does an excellent job in doing amazing interviews. He gets some really, really interesting guests on the show. All right, I'm glad to see you doing well. Stay around there. We're here every Wednesday, 8 o'clock. 8 o'clock is. Just stay tuned. Put the notification bell on. Click the notification bell on. But I'll be here on Wednesday. I'm going to start surprising y'all and getting here early. But let me see. Something to talk about real quick. Tax filing deadline. The extension of tax filing deadline is coming up. It is upon us. October 15th. Well, October 16th. Taxes should be in. If you've not done your taxes already, get them done now. And I'm getting beat down by all that right now. All right, so yes, thank you. All right, so Anthony says we cannot afford it because the government's biggest money generator is student loans. The government's biggest money generator is taxes, by far. Not student loans. And I wonder how many people are actually paying their student loans. I just saw today Biden pardoned, I don't know, I forget how many billion it was. Did anybody see that? I said Biden canceled some student loans today. But student loans just got restarted, y'all. So, all right. So Biden cancels another $9 billion in student loan debt today. $9 billion. All right, so keep that in mind. Let's share this real quick. So another $9 billion. But student loans, I believe it's as of October 1st, are back on the table, y'all. And I believe that the average student loan is going to be somewhere between $250 and $350, $250 and $350 a month. All right, so Biden canceled another $9 billion in student loan debts. Okay, woohoo! But I want y'all to pay attention to these politics, y'all. You canceled a whole lot more, but the right wing, the conservatives, the orange monkey followers, previous president, if you don't know what I'm talking about, said, no, we don't want people to get their student loans discharged. Even though they pardoned billions of dollars by way of tax subsidies, they pardon billions of dollars annually for corporate tax subsidies. Look up the corn subsidies. And these are corporations that are profitable. They don't need no subsidy. But yet, the right wing is for that. Talk about hypocrisy. But again, I like to talk about politics in an objective fashion. It's really hard these days because there's a whole bunch of malarkey going on. And a couple of years ago, I would say black folks should look at the Republican Party. I don't say that now. Nope. They too crazy. And if we do have another shutdown, it will be because the Republicans want to bring some more craziness to the table and take away things like childcare and other things that really are important for the health of a nation. But all right, we're going to get back to the bonds in a minute, y'all. All right, you weren't one of them. So your student loans didn't get canceled. All right. Listen, I still got student loans, y'all. Pray for me. All right, Thunder says another way to buying savings bonds. All right, we're not talking about savings bonds, though. But the Thunder's point, I'm going to read it because it's a good point. Another way to buy savings bonds is with your paycheck and spending a percentage sending a percentage to the account every pay. That is correct. You can buy that. But those are I bonds, right? We're not talking about treasury bonds and what he's talking about. Those are I bonds or EE bonds, savings bonds. Yes. And this is another good point, right? Also, if you want paper bonds, you can only get them once a year through your income tax form 8888 part 2. All right, I think Thunder might be becoming a tax accountant now. What's up? You gonna work together? Let's get it. People need good, competent tax folks. One of the reasons why what I was left becoming, one of the reasons why I became a tax accountant again after no longer being an institutional money manager or financial advisor is because I'm really into this whole thing about community involvement and helping, right? And to me, the first vanguard or the first line of defense for the Black community in terms of financial education is their tax professional. So if you have a good tax professional that you trust, they can do wonders in your life if you really trust them. Everybody doesn't always get it, but they can do wonders, especially if they're good and ethical. A lot of them are. I'm watching social media these days and I'm seeing a lot of these so-called licensed folks say all kinds of wretched and ratchetness these days. But it is what it is, y'all, right? Scammers want to scam, lions want to be lions. All right, so what I want to do now is I want to show y'all a chart real quick. Looking at treasury yields or rates versus the stock market and how they tend to kind of play off each other. Let's see here. Give me 1 second, y'all. And again, if you have any other questions, go ahead and throw them in the chat there, y'all. Give me 1 second. Let's switch gears here. So I want to look at the 10-year Treasury bond. And I also want to look at the S&P 500. Now, has anybody ever thought about buying treasuries before? Or are you like Lawrence and you think it's for boomers? Talk about ageism, right? Talking about what did Lawrence say? I gotta find that. I was cracking up. Such a character. By the way, did I say what's up to you, Marcus? If I didn't, charge it to my head and not my heart. What's up to you, man? I need to get you on the show, brother. I haven't seen you around as much. Oh, there we go. He said, "Boo, boomer bonds." So disrespectful. So disrespectful. Listen, every asset is a good asset. There are no bad assets. There are no good assets. They are just assets. Right? Just think of them as tools. No tools better than the other. They all just have a job to do. Oh man, they're making me fill out some stuff to get into this platform. That's because I haven't used it enough. I'm too busy working. All right, I think I see another question. Give me 1 second. I'll get right back to that. See a couple questions. All right, Akira says she's buying. What kind of bonds did you buy, Akira? But you're buying CDs right now. Why are you buying CDs right now? If you don't mind sharing. Hope I'm not getting too personal. But I do think us sharing helps everybody to grow. Again, I would never ask for your social security number. or your checking and routing number, or your bank account routing number. But, just some basic questions. All right, here we go. So I'm going to show this. And actually, I do need to change something. But bear with me 1 second. I want to show this so everyone can see this. So what I'm showing you right now is the Treasury yield. Now, actually, I probably should do a line graph or a line chart for this. So let me switch that up. Because what's on the screen right now are candlesticks. So now I changed it to a line graph. I think that's what it's called. It's been so long. Now I'm adjusting the time period right now. So I'm going to go to monthly. So each one of the charts right here, each one of the information dots are plotting for each month. So now I'm going back to 1963. So that's how far back they are tracking the 10-year Treasury yield. And so here's one thing I want y'all to keep an eye out about, right? So, all right, Anthony, I just saw that question. I don't get it, but I'll come back to it. So as Treasury yields go up, price goes down. This might take y'all a minute to get, but as Treasury yields go up, price goes down. I'm going to say that a couple more times. Again, as Treasury yields go up. So right now, Treasury yields are at 4.73. All right. That's because Treasury bonds have been selling off. All right. And so if we look here going back to July 2020, that was pandemic time. People were buying bonds. If you ever want to see what people are thinking, look at the stock market and look at the bond market, right? So I can look at this right now and I can look at this graph. Let me see can everybody see this graph? Does it make sense? All right, I'm saying you can understand what's going on because in July of 2020, Treasury rates, the 10-year Treasury rate, where'd it go? Missed it. There we go. I got it now. The 10-year Treasury rate was, in February, was 0.835. It wasn't even 1%. So that means the cost of borrowing was 0.835, less than 1%. Let me blow this up a little bit more. It was less than 1%. So now the cost of borrowing, because that's what the 10-year is, the 10-year Treasury yield is. The cost of borrowing, that's an overall benchmark for the cost of borrowing. So yes, getting back to how you can make money with it, when you buy these bonds, aka loans, because that's what they are, or IOUs, you are going to get right now 4.73%. Now there's some other factors, but I don't want to get into that today because I don't want to lose you in translation. But just know that all lending is based off of the 10-year yield. When you see mortgage rates go up, usually it's because the 10-year yield went up. There is a supply and demand. There is a supply and demand function of it that will change it around as well. But a lot of it is based upon the 10-year Treasury yield. which the Fed Reserve sets. But now, right now, going back to what I said, July 2020, the 10-year Treasury yield was at 0.719. All right. So the cost of borrowing money was 0.719%. That was COVID, right? Now, the Treasury yield goes down when people are buying bonds. So when people are buying bonds, the Treasury yield goes down. So that means people are making money as bond yields go down. People are losing money, or the amount, or the bonds are depreciating in value as Treasury yields go up. All right, I'm gonna add another layer onto this in a minute. Let me know if this makes sense to y'all. I don't want to put this out here if it's not making sense to you all. All right. So now the 10 year is 4.73%. It's going up. So that means the price of bonds are going down. Right now, there's blood on the street. All right, let me try to get this to y'all. Right now, there's blood on the street when it comes to Treasury bonds. There's blood on the street. And when is it a great time to make money? When you buy or when you sell? All the money is typically made when you buy. Because in order to buy and get profit, you have to buy at a great price. Because when you sell, if the prices are already exaggerated and fully anticipated, usually there is no opportunity for profit. It's already been priced in, so to speak. All right, but I want to just go back to this. All right, so again, when bond yields go up, bond prices go down. When bond yields go down, bond prices are going up. So just keep that in mind. Keep that in mind. And I want to just show you something. Now, let's see. How can I haven't used it in a while. Now, when I zoom in on this, the top level on the orange is the stock market, that represented by the S&P 500. When I look at the one on the bottom, that is the 10-year Treasury bond for U.S. Treasuries. All right. So, does anybody see anything there? Did anybody see anything there? Yields are going up. Stock prices are going down. But so are bond prices. But you can spot trends here. You can spot trends here when you really, really look at it, right? So what's happening in the stock market when Treasury yields are going down? They usually go down too. And then they tend to follow a lot of times. So they're kind of correlated. They shouldn't be as much, but they're kind of correlated. So you got to keep all of this in mind. If you have money that's supposed to be at that base, if you remember that we talked about the base of the asset allocation pyramid, that base is supposed to be what? Your support. That base is supposed to be cash and cash equivalents, or things like cash equivalents. So I never showed y'all the pyramid again. I showed y'all the video. I didn't show you the pyramid. And if you are all following this or have questions about it, go ahead and throw it in the chat. Mm. Oh, apologies. see this now. So again, let's see. I see there's a couple questions in the chat. Let's get back to it. And I want to show you all of this. I can't find it, y'all. Can't find it, y'all. All right, let's get here. Let's see what Anthony has to say. What money lessons can we learn from Charlie and the Chocolate Factory? I've never really watched that. I just learned, I think, off social media, right, that the Oompa Loompas, I think that's what they are, supposedly slaves, like actually African slaves. So, I don't know, but you might have to educate me on that, Anthony. All right, so Akira said yes, bought them years ago, but now buying CDs right now. All right, I did buy bonds a while back. It was encouraged in the military. I stopped after I started my Roth. Now you can buy bonds in your Roth. Right? Remember, your Roths, your traditionals, your 401ks, those are just buckets, right? They are not actual investments. They are just the buckets that actually house or hold the investments. All right, let's stop this for a moment. All right. All right, I'm guessing your CD is only 5.3%. That's cool. Nothing wrong with that. But as I was trying to not understand, I was trying to express earlier that you have to think about the risk that you're taking on. Banks do go out of business, right? So when you are putting money in a bank, there's a risk, there's a potential risk, not an absolute risk, but there's a potential risk. And I was saying that not to necessarily get rid of your CDs, but also think about treasury bonds, because you can buy them just as easy and there's no risk, none, because the government, as of right now, doesn't default on its payments. Now, one day, could that happen? Yeah. I'm not even gonna lie to y'all. But as of right now, I don't see it. But a lot of times, I probably won't be able to see when it's coming, just being totally honest. All right, but going here, I just want to go back to this asset allocation. I know that's probably not big enough for you all to see. Let's see. I think, all right, that's better. So we got the base, the middle, the summit, the foundation, the middle, and the top, right? At the bottom, you should have a lower risk because you are building out your foundation. You are building out your support, right? The stronger your foundation, the stronger your support. The taller the taller the building can be because it's able to sit on a base. Now, what are the assets for this asset allocation? Again, the foundation, the support level, cash and cash-like equivalents, CDs, notes, and bills, money market, bank accounts, government bonds, and debt. All right, that's all the base. That's all the safe stuff. That's all the boring stuff. When you look at the arrow there, what does it say? Low risk, all the way at the bottom, high risk at the top. Many of us do not understand what low risk and high risk is. We don't even understand how these assets, right? Because stocks are an asset class. How do they operate? How do they move? What moves them? We just say, hey, this works good. This looks so good. This looks sexy. All right. And in the middle is real estate, equity, mutual funds. Now, this is based upon an average, right? Typically, real estate isn't that risky. Sometimes it is. It all depends on how you're getting into it, right? All right. Large, small cap stocks, high income bonds, right? The bonds, high income bonds, they're different classes of bonds. It's like they're different classes of stocks. The high income rate, what does it say here? high income bonds. A lot of times those are more risky type bonds because they pay a higher interest rate. Risk reward when you again, I'm nerding out on y'all, and I apologize if I'm getting too nerdy for y'all. But when a thing to compensate for risk, a person, thing, organization will have to pay a higher level of a premium, whether it be interest rates or a potential return on investment, right? So that's what you had in that middle segment. At the very, very top, at the top of the mountain, at the top of the summit, at the top of the pyramid, options, futures, collectibles. I would also add in certain types of stock. I would also add in crypto. I would also add in NFTs. They all should be at the top there. All very volatile, meaning that their prices will fluctuate with the wind. They will go up one day, down the other, and then right back up the very next day for no reason at all. So spend some time getting to know these. Spend some time and go back and look at the historical charts, because that's all I did. I just pulled up these charts just to go back and say, all right, this is how these usually react. Again, there are no absolutes. There are no absolutes whatsoever. So then we go back here, okay. We're looking at 10-year treasuries. I'm going back to look and see, how do they act? How do they react? If I go back even further, you can go back and you look at big historical events. Anybody know what happened in October of 2008? Anybody know what happened in October of 2008? And Anthony, I didn't skip over your question. I didn't say it there. My apologies. I will get back to it. I promise. Remember,
it's only entertainment.
Let me say that again.
It's only entertainment.
Nothing on air is a recommendation. Let me change the screen for y'all. Nothing on air is a recommendation for an investment. Before you go and buy or sell any investment, talk to your investment advisor and your tax advisor, right? Past performance is not an indication of future results. So remember, everything has risk, even the safest things, right? Even when I'm talking about these treasury bonds, there's a level of risk to them. There's a level of risk to them all. But all right, let's go back here. Anybody know what happened in October 2008? Let's see. Did you really lose a chunk of your 401k? Did you sell? You only really lose money when you sell. I know that sounds crazy. The price might have went down. It was a paper money loss when it was in your account as long as you did not sell. Thank you. This is for educational this is for educational and entertainment purposes only, y'all. Do your own research.
It's only entertainment.
Don't forget that. All right. All right. It's only entertainment. Yeah, the value thing. But then the value came back. Now, when you look at this orange line right here, all right, let me go to 20. So that's 2007. This is October 2008. What happened in October 2008? The stock market tanked. The whole world was going crazy in bananas. Everybody was saying, run for the hills. Everybody was scared. And so a lot of people got shook and they sold. They went to cash. But then what happened? I almost know this by heart. I've talked about it so many times, right? So we go October 2008. Now, I don't know if you can see my crosshairs here. October 08, it was like in the 20s, October 20th or something like that, right? But we see a colossal fall. The orange line is falling. The blue line's falling too. But the blue line's falling, Again, remember, what does the blue line represent when it's going down? The price is going up. People were scared shitless. And they said, oh, Lord, I'm going to buy some bonds so my cash can be safe. So they brought treasury bonds, the 10-year treasury bond, as things got a little bit better, because the stock market bottomed out in March of 2009. I want to say March. Let's get it here. This says February. So yeah, March of 2009. The stock market bottomed out again. Keep your eye on the orange line. Keep your eye on the orange line. This orange line has been running. Now, I can almost probably figure out when this was. January 2020. What happened January 2020? Or what was about to happen? Anybody remember that? What was about to happen January 2020? Come on now. Y'all with me? January 2020. What was about to happen? And yes, Miss Edie. 2008 predatory lending, real estate got crashed in 2007. The stock market was crazy. You saw a lot of big banks go out of business. Bear Stearns, Lehman Brothers collapsed, went out of business. All right, so we got to care with COVID. All right, so y'all know what happened during COVID, right? The world went crazy again. Now, let's go here. January 20th. So I believe the shutdown happened in like March. So again, if you look at these graphs and you really get to learn them, they will be a great indicator, and they can tell you what's going on. And so here, March, it bottomed. Boom. What happens when it bottomed? It bounced. Blue line bottoms. That means it was making money. Now it's running back up. But then when it gets to the top, that means blood's on the street for the blue line. I'm on the blue line now. So if you buy, we're at the bottom now, right? If you buy at the bottom, what happens when you buy at the bottom? Well, here, this is the bottom for the stock market, the orange line. I hope I'm not confusing y'all. Let me know if I'm confusing y'all. March in 2020. If y'all remember, I was telling y'all to buy energy. I was telling y'all to buy Ford again.
It's only entertainment.
Some of y'all followed the advice. Some of y'all did not. Everybody that followed the advice likes me, like they love me. All right, so yes, so COVID was an issue. Now I'm looking at this orange line now. I'm just going to read it off to you all. It ran all the way back up December 21st. Now it's coming back down. And bonds have kind of been crazy because they don't know what to do with themselves right now. All right, so let's go back to this. And Anthony, put the question back up. I'm sorry if I missed it, sir. Because you asked me about the Willy Wonka, and I'm like, I don't know about Willy Wonka. All I know is they was in the chocolate factory running around with chocolate on, but I never watched that movie. You really don't know when you're in a bottom, Anthony. Okay, that's a great question. That is a great question. How do you know when you're in a bottom? If you understand that all of these things go in cycles, there's a top, there's a bottom, there's a middle, and if you can get an understanding of when the tops usually start and where the bottoms usually are, you don't necessarily try to time it and know where the top is or where the bottom is. You try to have a good asset allocation, because typically in a well-defined asset allocation, your portfolio can weather the storm. You might have some pullback, Well, it will typically weather the storm. I would study economic cycles. Let me see if I can find one. I know I've talked about them before. Peak and trough. I'm sure I've talked about that before. Again, media is a great resource for that. Let's see. You know what? Let me go back. Give me 1 second. We can talk about this. And this all kind of plays into this, right? When we talk about bonds. Give me 1 second, y'all. Un momento. Let's see. Okay, so Akira, you brought forward and you brought energy. How did you like it? Oops. Wait a minute. I just saw that. Did I lose it already? Oh yeah, I got it. Right. You said I did buy forward. And energy. All right, how did you like it? How did you like it? Listen, I might not be the most exciting or the most entertaining, but goddamn it, I might be the most valuable. Because I give education. Real education. At least that's my aim. All right, so I want to share this here, right? There's typically 4 stages of an economic cycle. So peak, remember I was saying peak, trough. So, and then I'll find a different one. Usually when you're in a recession or recovery, recession, starting from the bottom. Actually, I don't really like this chart. Let me find another one for y'all. Give me 1 second, y'all. Let's see what this one looks like. Let me find another one. Still buying. Oh, so that must mean you like it. Well, listen, I need a recommendation. I need a testimonial or something, y'all. Have any of y'all all left a review on my Apple podcast? Because remember, all of these shows are on Apple Podcast, and I do I'm tongue-tied. I said tongue-tied. I'm tongue-tied. And all of these, a lot of times, I will do separate, singular broadcasts that will only be podcast only, audio podcast only. So be sure to leave me a rating and review on the Apple Podcast. All you got to do is go over Apple Podcast, search The Finance Rebel Show, and you will find the show. All right, so here it is. Give me 1 second. Pull it up. All right, let me put it on the screen for y'all. And remember, you can always watch these replays live on the YouTube channel, Finance Rebel Show. All right, economic cycle. What is an economic cycle? Get y'all notes out, folks. The fluctuation of the economy between periods of expansion, which is growth, and contraction is recession. All right, now, stages of the economic cycle. An economic cycle is the circular movement, circular, not linear, circular movement of the economy as it moves from expansion to contraction and back again. So it's always coming and going, moving and going, here and fro. All right. Economic expansion is characterized by growth and contraction. So again, here where it says expansion, let me zoom in on this a little bit more so everybody can see it. During expansion, the economy experiences relatively rapid growth. Interest rates tend to be low. Interest rates are low. So if interest rates are low, what does that mean for bond prices? Put that in the chat. and the production increases, meaning that businesses are building things, are producing things, all right? The economic indicators associated with growth, such as employment and wages. So when you have strong employment, strong wages, or they're increasing, that means your economy is growing. Why? Because people can buy stuff. All right. Corporate profits and output, aggregated demand. These are all the things that are associated with expansion. All right. The supply of goods and services tend to show sustained uptrends. Everything is moving up. All right. Through the expansion stage. The flow of money through the economy retains healthy, and the cost of money is cheap. Keyword, cost of money is cheap. Again, keyword, cost of money is cheap, right? Why is everybody freaking out right now? Because the Fed increased interest rates several times. They were actually really delayed in doing that. They should have been did that. Because money was too cheap. Because they wanted the economy to keep growing and be resilient, because COVID smacked the hell out of it. All right. However, the increase in the money supply may spur inflation. Cheap money means increased money supply. Now, part of the reason why inflation is so crazy right now, it's not because of the money supply. It's right. It's not just because. It also increased because of COVID, because people could not get their things off the boat, onto trucks, delivered to the stores. Right. There was a stoppage of work because people couldn't work. Factories were shut down. Governments were shut down. All right. So peak happens when you get to the expansion stage, and it's like, all right, we're going. Like if you can think of an airplane going up to the moon. Well, if it doesn't have enough force and power, it'll stop. And as it's ascending up, the forces of gravity will bring it back if it doesn't have strong enough engines and enough fuel to go. It gets to a peak, and after a while, it starts to go back down towards the earth. So then you get the peak. The peak of a cycle is when the growth hits its maximum rate, right? It's at the top. Prices and economic indicators may stabilize for a short period before reversing to the downside, right? It's running out of fuel. It was going to the moon, like everybody was going to the moon. Remember, Doge was going to the moon. It never made it out of the atmosphere, but that's a whole other question. It clearly fell down to the earth. But people still talking about Doge, whatever, how you call it, right? Prices and economic indicators may stabilize for a short period before reversing to the downside. Peak growth typically creates some imbalances in the economy that need to be corrected. As a result, businesses may start to reevaluate their budgets and spending when they believe that the economic cycle has reached its peak. We're seeing this now. How many layoffs have we seen in the tech industry, right? All right, now when we look at contraction, a correction occurs when the growth slows, employment falls, right? Layoffs, and prices stagnate. As demand decreases, businesses may not immediately adjust production levels, leading to oversaturated markets with surplus supply and a downward movement in prices. If the contraction continues, the recessionary environment may spiral into a depression. So the depression, if anybody thinks about it, depression started in 1929 and went up to roughly 1944. All the war efforts brought the United States out of the depression. And again, a lot of that was government initiated because they needed to pump money into the economy, get businesses going so they could buy war materials and get everything going. But people were working. And so people had to people had the means to buy things. All right. And now the trough of the cycle is reached when the economy hits a low point with supply and demand hitting bottom before recovery. The low point in the cycle represents a painful moment, pain, with a widespread negative impact from stagnating spending and income. People are tightening up their purse strings, their wallets. The low point provides an opportunity for individuals and businesses to reconfigure their finances in anticipation of a recovery. What does that mean? There's blood on the streets. There's blood on the streets. They're reconfiguring their money and they're ready to buy some assets. So let's see here. There was a graph here that I wanted to show with all of that, all 4 stages. No, I know I showed it before. And let me go back. Here we go. This is good. This, y'all. Run the made up crypto coin. Yes, Lawrence. Yes, the made up crypto coin. Absolutely. But I mean, is it money made up when you think about it? But all right, let's look at this, y'all. So all right, here we go. Right? 4 phases of economic cycle, right? Expansion, which is phase 1, phase 2, phase 3, phase 4. The line, look at the black line here. Expansion kind of starts when you're in a recovery phase. You're coming out of recovery into expansion. You go up, you go to the peak, right? And I'll talk about some of these other things at the top in a minute. And then phase 3 is the contraction and everything falls down, right? Think about it like this. Expansion, sunrise, 6 a.m., 7 a.m., sun's coming up. Then we get to the peak. What do they call it? The zenith, or when the sun is at its highest point, and then it starts to fall. And then we get sunset. Everything's coming down in contraction. If you just think about it as a daily cycle, right? And then it starts all over again. We get to our lowest point of the sun as a relationship to the earth. And then as the earth rotates, the sun starts to shine. Excuse me, the sun starts to quote unquote shine again. And then it repeats all over again. Now, each one of these things here, it says outperformers, information tech, financials, communications, consumer discretionary. Then on the other end, so in the expansion phase, these are the industries and sectors that tend to do well, right? So if you have a pretty good idea of what phase of the cycle, and not to confuse y'all, it's really hard to predict it because the economy is very robust and it's forever moving. And we're not talking about $1 or $2. We're not talking about $100. We're not talking about thousands of dollars. We're talking about trillions of dollars that are moving and being generated and shifting and flowing. And so it's really hard to know what phase you're in until you're in that phase. So again, we're looking here. If you are in an expansion phase, it would be good if you were in financials. It'd be good if you're in information technology or tech, right? Or communications. Those are the sectors, the stock sectors or business that you want to be affiliated with. Now, when we're in the peak, again, what's good? Financials, energy and materials, right? Again, when you go to contraction, what's good? Healthcare. People are always wanting you to need healthcare. They're not necessarily going to be flamboyant with healthcare or overspending on healthcare because everybody needs healthcare, but everybody doesn't necessarily want healthcare. Consumer staples, your drawers, right? Things like that. Basic shirts, basic pants, things you need for everyday life. They'll always be there. Utilities, everybody needs electricity, right? Everybody needs gas. Everybody needs water. Utilities. And even cable now. In some instances, everybody kind of needs cable because their cable is tied to their internet. And then in a recovery phase, what do they need? Real estate, or what is good to be invested in? Real estate or industrials, because that's the phase where everybody's kind of coming back, getting back to business, and they're getting busy again. So when we talk about bonds, you could kind of look in the bond and how they work as it relates to your asset allocation. I feel like I might have over nerded out on y'all. I apologize if I did, but you can really start tracking a map for where you should be approximately when you get a better understanding of where the economy is, where the stock market is, and how it all relates and ties into your money. All right, so I want to answer these questions before I get out of here, y'all. And I guess the reason why I'm so late here, because y'all know I got to get my vittles. I ate before I got on, y'all. I'm still here. All right, so Akira says, honestly, at this stage where I don't like throwing my money around on funny money, the stock market, tired of seeing my money disappear. Okay, well, bonds are not the stock market. They're different. And again, all I'm saying is it might be a great place to put that base, your cash reserves, to get a little bit of a yield boost. All right, gotta go. All right, well, thank you, Anthony. Thanks for being here, brother. I'm still laughing at that. All right, so Anthony says, I asked Lady Chat, and she said you can learn. Money should not define your character. That's a fact. And it's essential to maintain a healthy perspective on wealth and its role on your life. I'm not sure who Lady Chat is. I guess he's talking about Chat GPT. Now, let's see. I thought Anthony had asked something else. Yeah, capital rights are crazy. I don't even know how we're having a discussion about those group of people who are okay with that. But again, if black folks did that, there'll be something different. And I don't even like to talk about it like that. All right, so listen, if this was helpful for you all tonight, at the end of this, there'll be a whole playlist on the replay that you'll be able to go through videos that I've done, I've talked about, that can help you get a better comprehension of investments and where you should go. And if you want, I'll do an even deeper dive on bonds, even though I don't know if y'all think it's super sexy. It's necessary, but if you want a deeper dive on bonds, go ahead and throw it in the chat, and I'll work on doing something else for that. But again, I appreciate you all. Until next Wednesday, I'll see you. I'll see you in the chat. Do me a favor, subscribe to the channel, and look out for this next video. I did a video talking about Jay-Z and should his cousin get money to invest and run the play. That's literally what they said. But until the next time, y'all, I'll see y'all soon.